Good afternoon, everyone. Welcome to today's webinar, Managing Risk with Options. My name is Scott Green, Marketing Director with Regal Securities, and shortly I'll be introducing our main presenter today, Ed Modla of the Options Industry Council. And as part of today's topic of managing risk with options, we'll be going over why we trade options, what are protective puts, what are collar strategies, pricing examples, and much more. And after Ed does his presentation on risk management, we'll have about 10 to 15 minutes for questions. If you have any questions at any time during the presentation, please either submit them to the chat box or there's a Q&A box. You can submit them as well, and we'll get to those at the end. And speaking of that chat box, I sent a hi welcome message to everyone. We also like to ask our audience a question. Who has traded options before? Please enter either Y for yes or N for no, so we can get a good idea of our audience today. Please use the chat box. Okay, seeing some responses, and a majority have traded options before, like we expected. I'd say about 90%, but that's fine. Please, if you have questions on of any type, please submit it, and we'll try our best to get to them. So next, I'd like to just share this disclaimer. The types of securities, forms, and research tools used in this webinar are for demonstration purposes only and should not be considered a recommendation by Regal Securities or a solicitation or an offer to buy or sell any options. This webinar is recorded and will not be intended to use for individual tax, legal, or investment planning advice. So without further ado, I'd like to introduce today's speaker, Ed Modla, Instructor at the Options Industry Council and Manager of Investor Services at the Options Clearing Corporation here in Chicago. Ed at the Options Clearing Corporation, he manages a team of professionals responsible for providing support and education for all products. At the OIC, he's a certified options instructor and creates education materials. Ed has a 20-year career centered around market analysis, ranging from trading floor to brokerage and education. And Ed is also a veteran of doing many webinars on these topics, and he's been a guest speaker at many live industry events as well. In fact, he is presenting at the Money Show in Dallas this October. So with that being said, Ed, thanks for joining us today. Please take it away.
Thank you very much, Scott, for that introduction, and welcome everybody for joining us here as we're in the second session of our three-part series working with Regal Securities. A few weeks back, we did some options basics discussion. What are options? How do they work? Some key definitions and core concepts. Today, we'll take it a step further and get into strategies, more or less on the basic level with how to manage risk using options. In a few weeks, we'll get into generating income with options. So hopefully during today's presentation, there'll be something in there for everybody. I know most people had said they use options before. There were some that hadn't. So for those at the basic level looking to get a good introduction, certainly our first presentation is very helpful. This one will be as well. For those of you on the other end of the scale, more familiar with options and a little more advanced, hopefully I can add some insight and some commentary along the way that you'll also find to be useful. Let's start with our risk disclosure. One second as we toggle the slides. There we go, the disclaimer. Options are not suitable for everyone. Individuals should not enter into transactions until they've read and understood the options risk disclosure document, otherwise known as the characteristics and risks of standardized options. You can get that by contacting your brokerage firm or by reaching out to OCC. There will also be examples in today's presentation, computations, risk profiles, P&L graphs. We won't include costs such as commissions, fees, margins, interest, and taxes. Those are important costs to consider, but for simplicity's sake today, we will not be going through those. OIC is an industry cooperative funded entirely by the Clearing Corporation. The exchanges also provide resources to us. The bread and butter of our education is our website, optionseducation.org. Also, we have courses, podcast videos, webinars, and a YouTube channel with a lot of those videos and past webinars. And of course, we have a great service, the Investor Services team. I manage this team. That email address you see on the screen, I'll put it up again later on today. You can reach out to us with questions. If you're trying to navigate the website, find material on a particular topic, or if you actually have an options-related question about a concept or an idea or a particular strategy, send us your questions and we're there to help. Our services, of course, are free of charge, just like everything else at OIC. We love what we do and we love hearing from investors, so make use of that email address. Send us your questions and we'll do our best to help you out. Over the years, options volume has increased dramatically. This is an annual look at contracts. On the left, those numbers are billions of contracts. You can see a sharp uptick at the turn of the century. Certainly electronic trading and the speed and access that investors had to the markets increased at that time. I also like to point out awareness. Around that time, arguably, is where investors entered the handle your own investments on do-it-yourself age of investing. That time frame coincides with where options increased in use, and investors like yourselves saw the great use in various ways to use options to diversify their portfolios. Volume has tapered off a bit in recent years. You see a spike there in 2011. Those of you that recall 2011, there was a variety of reasons why volatility was a bit erratic during that year. Certainly the Eurozone crisis was going on back then, and we had a bit of an uptick there in options volume, and it's tapered off. But if you think about the last handful of years, the markets have been relatively quiet, relatively steady. So it's not surprising to see volume taper off and not increase. In fact, it was encouraging to see volume maintained at high levels. I can tell you in 2018, we've got some months left to close out the year, but we are on pace to achieve or eclipse that 4.5 billion number from back in 2011. And that's no surprise either. The markets have been a little bit up and down. Those of you following it today in recent news headlines know that risk management techniques and the benefits of options are making their way into portfolios now more than ever before. So here's a list of exchanges that we work with: SIBO, NASDAQ, FOX, MIAX, NYSE. They all provide resources to us, and in conjunction with OCC, we're able to offer this type of education. Here's our outline for today. I'll briefly have a few remarks on using options, managing risk, and then we'll just get into the three strategies. Protected puts, I have a couple of examples there. Those of you who said you use options before may be very familiar with this strategy, but I'll put a second example up at the end of this one that might be a bit different way to look at it, and maybe you'll find that interesting. Collars, stock repair. Stock repair is a strategy not talked about too much. You don't see it as much. I don't get asked about it as much, so I included it here today because I think it's a valuable strategy for everyone to be aware of, and certainly for those that use options. If you're not familiar with it, hopefully I can introduce you to the stock repair today. We'll take some Q&A and wrap it up. So we'll start with risk management. Now, in general, managing risk is always important in our environment this year. It seems as though we're getting a few more questions centered around managing risk. That tends to happen when you get volatility spikes the way we have in the beginning of the year, when you get a market like we have today, when you get political news and economic news from around the world. People are concerned about managing risk. If you're not using options and you're just trading stocks, your choices are somewhat limited. There's certainly things you can do. You can go into non-correlated assets. You can go into bonds. You can toggle your exposure between the market and cash and hold a certain percentage in cash and fluctuate that. But with options, there's more things that you can do, and we'll discuss a few of those choices today. In general, there are main reasons why options are used. Income generation, for sure. That involves selling options, bringing capital into the portfolio. That can benefit you in a number of ways. The break-even points, your chances of success. We'll touch on that a little bit today, but we'll focus on that in a few weeks when we do session number 3. Stock acquisition will also be in that third session. Today's all about risk reduction, a prominent feature in the options space. So managing risk is very important, and options can provide that alternative use of managing your portfolio and provide insurance. And that's what we're going to get into with our first example. Sleeping easy at night, having peace of mind of knowing just how bad things can get is very valuable for investors and their mindset and their psyche as they're investing their money. So protected put, let's get started here. Investor in this case is bullish. If you are doing a protected put, there are two components to this strategy. One is you own shares of stock, and the other is you own a put option. Most of you are familiar with options. For those of you that aren't, reflecting on our first presentation, if you own a put option, you own the right to sell shares of stock at a particular price. That establishes a floor. No matter how low the stock price gets, you have the right to sell your shares at the price of the option that you own. So things can't get any worse than that. Now you pay for that. In options, when you're evaluating a trade, there's always going to be a cost and a benefit. To get this benefit, we have to pay for it up front, and that's the cost, the upfront cost of capital that we have to acknowledge to get this benefit. This is the traditional insurance policy. We have insurance on the stock moving lower. We pay for that up front. An option lasts for a certain length of time. That works exactly the same way as an insurance policy does. The profit remains in the long stock position. That's why the first words on the previous slide were the investor is bullish. We're protected on the downside, but we're still bullish overall. If the stock price moves up, we will profit in that case. Now, the stock price does have to move up by an amount equal to what we paid for our insurance in order to break even. So our break-even point has moved a bit higher. We know that. Also, the strike price of the option is where we are allowed to sell our shares. If we own shares at $80 and we buy a strike price of $70, that's the strike price where we can sell our shares. That $10 difference, we're willing to give up. We're protected from 70 and below, but we're not protected from 80 down to 70. So just like in insurance policy, sticking with those terms, that move from 80 to 70, that $10 functions just like a deductible of a policy. So now we have coverage, and we can analyze the market just the way you would various policies. How much do they cost? What's the deductible? How long do they last? You look at what's available in the marketplace, and you decide which one you want to go with. Now, the market is going to offer you a lot of choices. If there are listed options on a particular stock, you're going to have options that expire potentially every week, going out a few months, 60 days, 90 days, maybe longer, up to a year, year and a half. You're going to have all sorts of choices on stock strike prices and all different forms of deductibles. So you'll have a lot of choices, and you can find those within the options chains, and that's where you can evaluate. And that's where we're going to start with our example. Stock's trading at $100 a share. We own 300 shares, and we bought these at 95. So we've seen a 5% rise in our stock price. We're still bullish. We still think the price is going higher, but we want to give ourselves some protection. Now, if something awful happens, bad earnings report, surprise news, who knows what might happen. We don't want to wake up and have something awful happen and see this stock trading down 20, 25%. So we go to the options chain. Brokerage firms are going to present this in all sorts of different ways, but in this case, you see the month, the strike price, and the bid ask. Now, for you beginners out there, the bid is the best price that market participants are willing to pay for the option. With this strategy, we're also trying to pay or buy the option. The ask price is the best price market participants are willing to sell this option. If we're buying it, that is the best price available to us. So looking at the top line, the August 90 strike put option is 70, bid at 80. We could pay 80 cents and buy that option right now. We could join the bid at 70. We can try and go in between at 75 and work a limit order to buy there. We have a choice depending on how aggressive we want to be. With our example here, we're going to go out further in time and we're going to pay the ask. So we're going to go to September, the 92 half strike, and we're going to pay the ask of $2. Now remember, each options contract's premium amount is quoted on a per share basis, and each contract delivers 100 shares. So that $2 premium amount represents $200 per option. We buy 3 of these options because we own 300 shares, strike price $92.50, $2 each, 3 times. That means we paid $600. So $2 times 100 times 3 of them, that comes to our cost of this insurance policy of 600. And we'll get to the P&L graph on the bottom. I'm not going to go through all the numbers. They're color-coded, so you can just see how this effect works out on your portfolio. The protection doesn't kick in until 92.50. You don't see a benefit until you get to that point. At 95, for example, and remember this is at expiration, at 95, our insurance isn't worth anything. Our right to sell shares at 92.50 when the open market is trading at 95 isn't worth anything. So we lost, or you could say didn't use our insurance policy and it expired. We lost $600. Our stock price went back to its break-even point. That's where we originally bought shares, $95. So in this case, $600 is the net loss. As you move up in our hypothetical stock price at expiration, the overall portfolio gains in value. And ultimately, that's what we want to see happen. But what's worth noting here is on the upside, we're not using our insurance. So our profit is muted by the $600 that we paid up front. Those two are not the best results for this strategy, even though you still might be comfortable with the fact that you know you had risk measures in place. The benefit to the strategy is the downside. While it's constructed, this portfolio of long stock, long put cannot get any worse than a loss of $13.50. Below that stock price at expiration of $92.50, the put starts to gain value, and it will gain value at the same pace as the stock portion loses value. They offset each other all the way down. The stock can go to 80, 70, 60, doesn't matter. That loss of $13.50 cannot get any worse. And that is where the protective put pays off. We know going in that we have an upfront cost, we have a deductible, but we're doing this. We're doing all of that for this downside protection in case something bad happens. You can put all of those numbers and clean them up into a nice profit and loss chart. The green dashed line is long stock. Notice the break-even point. From the long stock, we're making money above 95 right away. If we decide to dip into our pocket and buy an insurance policy with a strike price of 92.5 and pay $2 for it, our stock price has to come up by $2 to pay us back for that cost of insurance. That puts our break-even point on the protective put at 97. So a worse break-even point, slightly worse performance to the upside, again, by the amount that we paid for that insurance. But on the downside, and you can see here clearly we're not drawn to scale, you can see 90 all the way down to 0. That is a fairly large amount of space there. The protective put will pay off for you. One of the hardest trades that anyone has to force themselves to make, and believe us, we've all been through this, when you have a losing position and you have to exit at a loss. It takes a lot of discipline to do that, and it's more or less natural instinct to want to stay in trades, hoping they turn around. Protective puts are a way to force that discipline on you and pay for the insurance, and if things really go south, you get out at the price that you told yourself you were going to get out at without giving yourself the chance to let a stock trade get really bad. So here's example number 2, and this is coming from a different angle. The first example was a stock position. Now we're going to look at a portfolio, and how could you use this strategy on an entire portfolio that it contains a large number of stocks. So here we have a $100,000 portfolio. The first condition here is we have to recognize an index or an ETF, and for my example, we'll just say it's an ETF, that closely resembles the performance of the portfolio. In other words, we feel that the performance of our portfolio is going to be highly correlated with the performance of this particular ETF. We don't want to sell off our positions because they're still bullish, but we're cautious and we want the protection, and we want to do a protective put to do that. So for 3 months, we want to buy protection. We want to limit our downside risk beyond a 10% correction. That means we're willing to give up 10%. That represents our deductible. Beyond that, we want our portfolio protected. And we're going to go ahead and buy puts in an ETF that can cover the losses in our portfolio. You're going to have a bit of a different analysis here than we had before. So we'll start with the value of 100,000. If we get that downside move of 10%, we'll lose $10,000. That's our deductible. We're willing to get rid of that 10%. That would leave our portfolio with $90,000. Now, let's say we find an ETF out there that we think is going to be highly correlated with our portfolio, and it's currently trading at $250 a share. If we get that downside move of 10%, the ETF, in theory, would be trading at $225. That defines our strike price. Now we know what strike price we want to buy. Second question is, what expiration date do we want to buy? 1 month, 3 months, 6 months. We said on the previous slide, we're looking for 3 months of protection. That's a personal decision. How much are you willing to pay? How long out will you have this protection for? In this case, we're buying a 225 put 3 months out for $3 per contract, or $3 per share, $300 per contract. Now, the next question that I get frequently at my desk from advisors and money managers is, how many of these am I supposed to buy? I'm protecting $90,000. I know which put option I want to buy, 10% down for 30 days or for 90 days. How many am I supposed to buy? And here's the way I explain that. Creating a hypothetical situation. Imagine all stocks and all indices went to a price of 0. Everything in the market went to 0. If that were to happen, your portfolio would lose the entirety of that remaining $90,000. If we are completely hedged with this put option, that means we need to be hedged to an extent where we bring back all of that $90,000. So let's think this through. If we own one put option at a strike price of $225, what would happen at expiration if we exercised it? Well, on one side, we'd get paid $225 times 100, or $22,500. And on the other side, we would have to deliver something, shares of stock. But in my example, those shares of stock aren't worth anything. They're worth 0. So we would get paid effectively a net amount of $22,500. But we're trying to protect $90,000. So if we actually wanted to hedge the portfolio in its entirety, the formula is fairly simple. You take the total dollar amount you're trying to hedge in your portfolio, divided by the total amount of cash that you would be paid from your strike price on the option that you're looking to buy. In this case, that's $22,500. That goes into $90,000 4 times, which calculates out to 4 put options. That's how many we would have to buy to be fully hedged on this position. That also helps us derive the total cost of this protection. $300 per contract times 4 is $1,200 of an insurance cost. From this point, we can then evaluate, am I comfortable with $1,200? If you are, you can make this trade. If you think it's a low amount of money, maybe you change your strike price. If you think it's a high amount of money, if it's too much, there's a couple things you can do. You can buy fewer of them, buy 3 or 2 or 1, and recognize that you haven't entirely hedged the portfolio. Or you can look at changing your strike price and lowering your strike price. Now, that would increase your deductible, your exposure to the downside, but lowering the strike price would also lower the premium amount. But this is the process and the calculation that you would go through in order to make this type of analysis. And here's a graph. Similar to before, we won't go through every number, but visually you see the green and the red and how all this plays out. The hedging cost is a constant $1,200. That's in the middle, straight up and down. $1,200 is our cost of insurance. That's not going to change. Now let's look on the left, index ETF. Let's just say it doesn't move. 250, the percent move in the market is 0, which means the ETF didn't move at all. Our expected portfolio loss or gain is 0. We lose the cost of insurance. Our put value is 0, so we lose money here. If the market moves nowhere, our loss is the insurance premium of 1.2%. To the upside, similar to the first example, we gain as the market moves higher. The gain on our expected portfolio is going to add to value in our portfolio, but it will be muted by the amount we paid for that insurance. The expected move, say, of 20%, the top line. Even though our portfolio gained 20%, we lost $1,200 on the hedge, so the net amount is 18.8%. We're willing to take a slight decrease in profits to the upside to get the benefits on the downside. You see the downside in red, percent move, 10, 20, 30, that can keep going, 40, 50. The expected portfolio gain or loss is going to be constant at 11.2. And again, this is a slightly more complex analysis because we have an ETF that we've evaluated to closely resemble our portfolio. So there could be some slippage in those two prices. But in theory, we've still capped our losses at 11.2%, and that's the beauty of the protective put strategy. Number two is the collar, and we're going to use some of those strategies, some of the strategy concepts that we just discussed, and then add a wrinkle to it to change things up just a bit. Collar can be considered two strategies in one. On the downside, it's just what we talked about, the protective put, long 100 shares of stock, long a put option at a particular strike price. We chose the strike price. We chose the expiration date. We know what the premium amount is. There's a deductible attached to it, and the profit is in the long stock position. The other side to the collar is a covered call. And to foreshadow session 3 in a few weeks, OIC will be covering the covered call in great detail. But what is the covered call? Briefly today. Covered call has two pieces to it. An investor buys 100 shares of stock and they sell an out-of-the-money call option. Selling that option puts the investor under the obligation to sell those shares. If the option holder decides to do so with the covered call, you're willing to do that for the premium. That's the primary goal. Increase returns, increase cash income into the account by selling that call option and generating additional income. As an isolated strategy, it's still bullish. It's still fairly neutral. It can somewhat be considered risk mitigating because you have a lower break-even point. But the two pieces, long 100 shares and short a call option. Like any other short option, you're under the obligation to perform if called upon to do so. In the case of a call, you might have to sell your shares at the strike price at the sign. What that means is you give up upside potential participation if the market increases rapidly. Assignment could occur on any trading day. I'll add a piece here. That normally doesn't occur. It's a fairly rare occurrence for early assignment to happen. It certainly can. The most common occasion for that to happen would be in the case of dividends. If a call option holder would like to receive that dividend payment, they might exercise their option so they can get those shares in time to get the dividend payment, and they might do that before expiration date. Outside of that circumstance, it is fairly rare to be assigned early. The other potential example is if the options are deep in the money and they can be converted or exited fairly easily. So those are things to consider, but in theory, assignment could happen on any trading day, and in return for that, in return for the obligation to potentially have to sell your shares, for that obligation to exist every day, you are paid upfront, non-refundable option premium. Here's a snapshot of the covered call in risk profile format, long stock on the left, with your P&L on the vertical axis and the stock price on horizontal. As soon as the stock price starts moving higher, long stock makes money. If the stock doesn't go anywhere, you break even. Notice on the covered call side of things, if the stock stays right at break even, doesn't go anywhere, doesn't move, the covered call actually profits a little bit there, and the profit is equal to the amount of premium from the option you sold. So your break-even point's a little bit lower. The slope to the graph to the downside is the same. On the upside, you give up that upside potential with the covered call. You'll slightly outperform the long stock position until you get to your strike price. And then as the stock continues to run higher, at that point, the covered call has maximized its gains. So let's put these together. A few slides ago, we said it's a covered call. So this is used for income, and we're going to use it there in this case. We want to generate that income because opposed to just doing a protective put, we're going to try to not pay any money out of pocket to get protection. So we're going to sell an out-of-the-money call. We know our upside profit is limited by doing that, but we're going to use that premium to control our costs and keep our out-of-pocket expense as low as possible. The reasons why you do this, you still have upside potential. You can gain in upward moving markets up to your strike price, and you're protected. For example, if you are targeting an exit price in the stock, you can sell a call option that obligates you to sell shares at that very price. Meanwhile, if you're also concerned while you're waiting for that price to come to fruition about the downside and about a move in the other direction, you can buy a put. So effectively trying to sell your shares at the strike price of the call, but having protection in place and not having to pay for that out of pocket up front. That's a key benefit. Now you have to know while you have this position on, your risk is still in that long stock position all the way up until your put strike price kicks in, and that is your deductible. So you have questions to ask yourself when you're doing this strategy. Do you need downside protection? And if you do, how much? Upside participation is certainly something you're looking to capitalize on here. If you didn't think there was any potential for the stock to move higher, you wouldn't do this strategy. So how much upside are you looking to capture? You have to strike a balance between those two things, because as you look up and down the options chain, you will see different premium amounts for different strike prices of puts and different ones for calls. We're trying to do this at even money or to not pay anything. So we have to balance how much risk are we willing to take, how much reward are we looking for. We can sell lower strike price call options and get more premium paid to us. That's great. But we're also going to have to give up our shares at a lower stock price. That's what we give up. Same thing on the put side. We can go lower in strike on the put and pay less for it. That's good, but that provides us with less risk control or less insurance. So you have that two factors, the risk reward on each side to balance as you choose your strike prices. Now let's take a look at an example and run through some hypothetical scenarios at expiration. In this case, the stock is trading at 61.50. We look at our options chain and we discover that the 57 put and the 64 call are trading at the same price, $1.50. So we can sell that call and buy that put and accomplish our net cost of zero, no credit and no debit. And you can see on the left how that risk profile looks. Our break-even point is still at 61.50 because the options transactions did not include cash in either direction. On the right side of the screen, we'll start at the top. If the shares drift all the way down below 57, our insurance kicks in. We can sell those shares at 57, get out of the trade. The short call isn't worth anything. That expires. Basically, in this case, we've utilized our insurance. We've exited. We took a loss from 61.50 down to 57, and now we're out of the trade. We have no position. In the middle, if shares settle between 57 and 64, the options become irrelevant. Both options are out of the money. We don't need our insurance down at 57. We're not going to get called away and have to sell our shares at 64 if they haven't reached that point yet. So the options would simply expire. The P&L is still going to be a result of the long stock position. Where are we trading? Is it at 60 or 61 or 63? And we will still have a position if the shares settle here. At this point, we decide, do we do another collar? Do we sell a call option and not buy the put? Do we buy the put and not sell the call? Do we exit? We have all sorts of choices on what to do at that point. And the third possibility, if the shares settle above 64, our insurance certainly isn't worth anything. That goes away. We will get assigned on our 64 call if the stock's trading up at 65 or 66. The person who owns the call option, giving them the right to buy shares at 64, is going to want to do that. So we're going to be assigned selling our shares at 64, and we will have no position. One other comment about the collar. One of the beauties about options is how many different things you can do and how versatile they are. If you have a larger position, there's different things you can do. Our examples are long 100 shares and then one option on each side. But let's say you had a position of 500 shares or 1,000 shares. In that case, you have a whole world of possibilities. You can decide for yourself, how many puts do I want to buy and how many calls do I want to sell? In fact, this type of analysis of toggling volume can exist on almost any other option strategy. But if you decide on the collar, let's say you own 1,000 shares and you decide, I'm going to buy 6 put options that protect some of that portfolio. I'm going to sell 8 call options to the upside. That might give me a net credit overall. So I'm going to bring some cash into the account, have some protection on the downside. If the stock rallies sharply, I'll give up some of my shares at 64, but I'll hold on to a little bit. There's all sorts of different things you can do with options, not just in construction of strategy, managing risk and bringing in income, but also managing those volume numbers, how many shares versus how many options you trade when you enter the trade and when you exit as well. All sorts of things you can do there. Let's get into our third strategy now. This one, like I said, is not as talked about as some of the others, but very valuable. There's 4 moving parts to it. It's certainly not confusing, but since there's 4 pieces, you have to stick to it and think it through. This strategy also has a precondition. It's not constructed in its entirety, or I should say it cannot be instructed or constructed in its entirety. There has to be a precondition first, and that is what you see at the top here. Buy stock, you own stock, and it declines. Now what do? You can always exit. You can do nothing. Maybe that means you're hoping for a turnaround, or maybe you are confident that the stock is going to turn around and rally higher, or you can maybe double up. That means buying more shares, what some people consider cost averaging, buying more shares and lowering your break-even point. Or you can do something else, and this is where the options game can come in. You can effectively accomplish that cost averaging concept through the options market, lowering your break-even point. However, you can also do it with an additional benefit and a cost. The benefit is you don't have to buy more shares, and you don't have additional downside risk. What you give up to obtain that is the inability to profit to the upside. So that's what this strategy is all about. Your downside risk remains the same. Your upside is now given up, in effect, but you don't have to pay for this. You're not paying for additional protection. You're not paying to try and lower your break-even point. You have this trade-off of upside profit potential that you're giving up or minimal in order to lower your break-even point and get out of this trade that is already sitting in a losing position. So what is it? You own 100 shares. They've dropped. The options portion of this involves buying 1 call option and then selling 2 call options at a higher strike price. Let's think that through. If we buy a call option, we now own the right to buy another 100 shares. If we do that, we have 200 shares. We've sold 2 call options at a higher strike price, which obligates us to sell those 200 shares at the strike price of that option we sold. And that's where giving up the upside potential comes into play. We're obligated to sell those 200 shares if the stock rallies all the way through. However, you can likely accomplish this at little or no cost. There are no uncovered calls. Like we said, you are under the obligation to deliver 200 shares, but we already own 100 of them, and we can buy another 100 because we own a long call. What we're trying to do here is recover the original investment. We want to get out of this trade that we don't want to be in anymore. We don't think it's going to rally as high as we thought. We want to get out, but we don't want to get out of a loss. We think there might be a bounce in the stock coming. So without taking additional downside risk, maintaining the same level of risk we currently have, not paying any additional cash, we're going to lower our break even and be comfortable getting out and exiting the position at the break even point, realizing if the stock rallies sharply, we give that up. Before we get to our example, here's how this is constructed. And from a general sense, you're choosing 2 strikes for your call options. Usually it's right at the money for the call option you buy, and for the call option you sell, it's usually about halfway in between the current loss that you're sitting on. You'll have to start there, analyze the option premiums, and see if you can do that at 0 cost if there's a slight debit or credit. You also have to choose an expiration month. The longer out you go in time, the greater likelihood you have of getting a 0 cost or maybe even a credit. Shorter term options are going to be more sensitive. That might be beneficial to you. If you do the longer term route to try and get a credit or zero cost, you might tie up your money for a longer period of time. And in addition to that, the stock has more time to move against you. So you have to consider those risks, the costs and the benefits. Here's our example. We bought 100 shares of stock XYZ at $70. Now it's trading at 60. We've lost 10. We think a bounce is coming. We want to get out of this trade, and we're comfortable doing it at break even and not worrying about the stock going incredibly higher through 70, 75, 80. We want to get out of this trade, and we think we can do it at 65. We don't want additional risk. So we go out 2 months, and we establish what really is known as a 60-65 call spread 1/2. I come from the trading floor 20 years ago at the CBOE and in New York, and that's the way this trade would be quoted in the trading pits. 60-65 call spread 1/2. In this case, we as the investor are buying the 60-day 60 strike price call, open market value $3.50. And then same expiration date, we're moving up to the 65 strike and selling 2 of those calls at $1.75 each. You can see the simple math. Buying 1 at $3.50, selling 2 at $1.75 each results in no cost. So now we have 100 shares of stock. We own 1 call option, which gives us the right to buy another 100 shares. And we're short 2 call options at 65, which obligate us to sell both of those 200 at 65 if we're required to do so. We didn't pay any money. We have no additional downside risk. We have the same downside risk as we had before, and now we have some protection with options. If the stock goes to 60 or below, we're in trouble. This is worst case scenario. We're still long 100 shares. So the options are worthless. They're not worth anything to us. We're still susceptible to losses to the downside on the 100 shares that we own. So this is the worst case, $60 or below. If we're between 60 and 65, we're starting to get some of that money back from the long shares. We're also starting to gain a little bit from the long call option that we bought at 60. That's now in the money. So we're gaining some of that money back, and we have a partial loss. At 65, this is the key level, at 65. Our stock position that we bought at 70 is down $500. Our options are up $500. The 60 strike call we own is $5 in the money. That's worth $500. We didn't pay anything for these options, so we profited $500 on the options. That is our break even. And on the bottom, you see if the stock goes above 65, any stock price increase is going to be offset by a loss on the options side of this spread. So we are capped. We cannot make money in this example, but we can get out at 65, break even, move on to a new trade. And we didn't pay for it, and we didn't add additional risk to the downside. That's where this trade really pays off. P&L graph, we'll start with the chart. I'm not going to go through all of this, but I'll just point out a few key levels. 65, again, the stock profit and loss, down 500. The options, you can look at both of those. At 65, you have a net profit and loss across the board of 0. 70 strike is where it gets interesting. So the stock is back to our break-even point, and we have a gain on one option, a loss on the other that net each other out to 0. And you notice that's where it is on the upside. 70 and above, 65 and above, we can't gain anymore. We've given up that upside potential. To the downside, as the stock moves lower, our losses will continue to mount, and that's where our risk is. But the premise to the trade was we were still somewhat bullish from the level we went to, which is 60. We thought the bounce was coming. We thought a slight move higher was coming. So that's where this trade came in. The benefit to having done this versus doubling up, of course, or cost averaging with shares is that loss, if the stock continued to drop 55, 50, that loss is the same as it would have been by just holding 100 shares, which is this case. So hopefully that is fairly clear on how this strategy plays out. Final comment about it. You can manage this a bit different. I mentioned that 70 strike being a bit interesting. Let's look back on that 70 strike. So we had a 0 profit and loss on our stock, the net gain or loss on our options cleaned out. But think about this. Now we're back to break even here at 70. Maybe we just exit the options positions, get rid of them, and now hold the stock again. Maybe our opinion changes. If it goes back all the way to 70, we'll look at the option premium amounts. Maybe just close those options out or let them go and continue to hold the shares. That's back where we started before we even did this trade. That's something that you can consider if the stock starts to rally like that. So closing out the options would leave you back with the stock position. If your opinion were to change again, it certainly might. But options traders and investors in this space are generally trying to evaluate their opinion on a day-to-day basis. And if you do see that, certainly making those types of position adjustments would be a viable choice. So those are the three strategies. My last piece before we get to Q&A, our options education program is on our website. We do have a MyPath program, which has a course catalog, podcasts, videos, a very lengthy strategy section, some tools. We have calculators, options quotes page, and investor services. So our contact information, as we said at the beginning slide, optionseducation.org is the website. We recently redesigned it. It looks nice and slick now. The email, options@theocc.com. We respond to all of our emails within one business day, and we do take questions all day long from trading firms, exchanges, financial advisors, and investors. We're not licensed to give advice or market analysis or discuss someone's particular position. But when it comes to understanding options, certainly what we have on the website, and from an options concept perspective, we're there to help. So please reach out to us. Our YouTube channel is fantastic. Search the Options Industry Council YouTube channel. Check out all those videos there. Those are also on our website as well. And follow us on Twitter to find out what we're up to. As mentioned in the beginning, we're traveling. We're giving presentations in different cities throughout the country, throughout the year. So please follow us on Twitter, follow us, and realize where we're at and maybe participate in our future events. I think there might be some questions on the board. Scott, if you want to come back on, we can take some questions and then head into wrapping it up.
Of course. Thank you so much, Ed, for going over all those great option strategy. A lot of great stuff there. Just a quick announcement before we get to a couple questions. As I mentioned, this webinar is being recorded, and we will be sharing the recording of this webinar to all those who registered. So be on the lookout for an email from us that'll have a link to the recorded webinar in case you want to watch it again. Let me go back real quick and see what our question box looks like. Yeah, I got a couple questions about it being recorded, and so we addressed that. Let's see what else we got. Okay. One question I know we have is, Ed, if I own a protective put and the market sells off, how do I determine when or if I should sell the put?
Very good question. So when the market sells off, of course, your portfolio would have expected to have lost value. The put option itself would have gained in value. And the analysis at that point is, well, do I continue to hold this put option? Or as the question suggests, do I need to sell that put option and cash out? What I'd say to that is, of course, I can't give a cut and dry answer on that, but there's two things that you're always doing when you're trading or investing or managing your account. You're managing the positions you have in your account against your market forecast, and you're also managing your money. I think that second part some people tend to forget about, or it slips through the cracks. You're managing your money as well. So those two considerations work in conjunction with one another. If the market has sold off and you've seen some losses in your positions, but the put option has gained significantly, you're starting to think to yourself, maybe I should sell this put option, get rid of the insurance, and cash out on that policy. There's a couple things to consider on the position side. If you think the market might turn around and start to head higher, it's starting to bottom out, that would be a good time to potentially sell that put option if you think a bounce is coming, and then you can decide at a later date if the market does rally, whether to put that put option back in place. But also managing the money part, even though you see a nice healthy amount of money sitting there for you in the put option, if your account has suffered some losses, maybe in some other areas, or maybe the deductible was large, and you don't feel like you can afford financially to give up more losses in your account, you may not be in a position where you can afford to sell that put option and expose the account to a further move to the downside. So those considerations all come into play, and I think the closest thing I can give to a direct answer, if you wanted to sell the put option, would be to make sure it's consistent with your forecast on the market. When you do have sell-offs, you could see some consolidation, you could see some bounces, and if you think that's coming, then evaluating the premium and the put option and deciding if you want to sell it might be a consideration.
And we have another question from Andre. Is it better to use this stock price as stop loss price point, or are you looking at the options percentage movement? A few percentages in the stock movement can be quite drastic in the options, having a hard time figuring out a safe stop.
A safe stop. Well, I believe the question is asking if we're using the options as a stop. And I think that more or less pertains to the protective put. So when you're going out of the money on your put option and you're trying to determine, how far out do I go, what percentage stock movement I'm willing to tolerate, I agree that some of the examples may seem quite large, but it's somewhat of an individualized analysis. Buying puts can either be protecting your money against a downside move or protecting catastrophic moves in the market. One investor may view that different from another. So when you say you're protecting against anything greater than a 10% move down, some investors may think, well, that sounds like a lot. But a lot of investors are using that put option strategy to protect against a massive move lower and a huge correction. And if you've been around long enough, you've seen one or two or more of these, and just how painful that can be for a portfolio. So going that far out of the money for someone who's protecting with that objective might not seem too far. But it's difficult to get more fine with the answer than that, because it is somewhat individualized. If you feel like the protection is so far out of the money that it's not worth that stock price move to do it, well, then you have to consider maybe other choices. You could go a few percentage points out of the money and consider just using a simple stop loss in the stock itself instead of the put option. You can do that. You do have some risk when you do that, of course. You could be filled at a bad price. You have overnight risk. You have weekend risk. With put options, you don't have any of that. But it's certainly a consideration, but I think it would be left to each investor to decide what's best for them when they consider where to make those choices.
We have another question from Jerry. I've heard the covered call referred to as a risk mitigating strategy. Would you say that is true?
I would say it's in the category. I may have briefly mentioned that when we went through it today. The reason why some consider the covered call to be risk mitigating is because since you've sold a call option against the stock position and you've brought in some capital, if the stock doesn't move, you do profit a little bit. And if the stock drops by the amount of premium you received, you break even. So there's this slight buffer to the downside that the covered call provides to you. And in that sense, it is risk mitigating. Now, it's not considered a risk strategy. Didn't include it here today because there isn't true downside protection. If you remember the P&L graphs I had up with long stock versus covered call, the slope to the downside of the covered call was still significant. You still have significant risk there. But as far as being risk mitigating, I'm not going to disagree with the comment because you do receive call premium and your break-even point on the trade is reduced. That gives you a greater likelihood of success on the trade. And in that sense, you have reduced your risk just in a very small amount.
A question from Andrew. Are you able to do covered calls on CFDs?
I'd have to check on that, Andrew. That would be a good question to send us to our email, so I would have to check on that. I know the areas that we work with at OCC and OIC are the listed contracts that clear at OCC, the listed product space. So you would have to just send that to us by email. We'll see if we can get an answer for you, and we certainly would be glad to look into it.
And just a few minutes left. I got one more question here from Samantha. With stock repair, can you explain why it is more likely to execute the options at a credit with longer term expirations versus using short term expirations?
Sure. Yeah, I didn't get too much into that. That is a great question, and it can get a little more complex. So I didn't provide too much detail on that. If you're thinking about at-the-money options or at-the-money strikes, it's somewhat of a gray area. If the stock's trading at $50, what strikes are at the money? And most people would say, well, 50 is certainly at the money, but also maybe the 52.5 and the 55s and the 47.5. And something very close to the 50s is the near the money or at the money options. Now, with nearer term expirations, you're going to have a greater disparity of option premium amounts as you move from one strike to the next. There'll be a greater difference between those premium amounts. And if you start to think that through, it makes sense. If you have just 1 day left till expiration, stock's trading at 50, well, the 52.5 call option doesn't have much value. There's only 1 day left, and it's $2.50 out of the money. But if you go out a year, the 52.5 call is going to have quite a bit of premium because there's a year there where the option price can change and the stock price can change. So the point I'm getting at is, as you go out to longer term expirations, the difference in premium amounts shrinks from one strike to the next, especially, and in this case, notably, for the at-the-money options. The difference between the premiums is going to be smaller. So if you're buying one and you're selling two, which is what you're doing with stock repair, and those premium amounts are closer together, it's much more likely that you're going to get a credit to do it versus the near term where the differences are much greater. If you're going very, very close, say 1 week or less, it'll be very hard to execute stock repair at zero cost or a credit because the call option you sell will likely have very little value, if any. But the longer term expirations are a bit different. I know that was a long-winded, fairly complex answer, and again, we can follow that up, send us an email, and we'd be glad to elaborate for you. But the point is, premium amounts at longer term expirations are a little bit closer together.
Great. Thanks, Ed, for taking the time with these questions. A lot of great detail. And thanks to the audience for submitting the questions. A lot of great questions out there. And as Ed said, you're welcome to submit any other questions to options@theocc.com for any more information. And we want to thank everyone for attending, and especially thank you to Ed for all the great information. So thank you, Ed. It was great, great having you. And if anybody has any questions, Ed gave his contact information at the OCC. You could also contact your broker at support@regalsecurities.com. We have a phone number there up on the screen as well. And this is our second webinar with the Options Industry Council. And we're going to have another one next month. We're still locking in the date on that. We also have other webinars with Options Play. If you've ever experienced our Options Play platform, our Options Play feature on our trading platform, we have one next week, next Wednesday on that. So be on the lookout for that email for those who have active accounts with our trading platform. But thanks again for everyone for attending. We really appreciate your participation. If you have any more questions, please send it to us. Be on the lookout for a recording of this, which we'll email to everyone. And again, thank you, Ed, for your time. And everyone, have a great rest of your day. Bye-bye.